Welcome to our Old Dominion Realty Live webinar. This evening we're going to be talking about real estate as an investment. I'm Pam Estes with Old Dominion Realty, and joining me this evening is Ron Ross with PBS Mortgage. And Ron, can you tell me how we contact you and where you're located?
Sure, we're located at 2040 Dyerly Avenue, right on the corner of Dyerly and Lucy. You can contact us 540-442-8583 or www.bbsmortgage.com.
Thank you. And also joining us is our accountant, Nick Perrine, and he's with PBMares. And can you tell us, Nick, where you're located?
We're at 558 South Main Street. It's halfway between the Quad at JMU and downtown Harrisonburg.
And Nick, how long have you been in the accounting business?
I've been with PBMares for 11 years now.
Wonderful, wonderful. Again, as I said to you earlier, we're going to be talking about real estate as an investment. If you have questions during our webinar, as in the past, I encourage you to email us at mail@olddominionrealty.com. I'll be glad to field your questions, either for Nick or myself or Ron. We'd be happy to answer those. We want to talk about real estate investment in two different terms. Nick, we had talked about owner-occupied, and I know in the past Ron has talked about financing for owner-occupied properties. And as an agent for my buyers, I talk to them quite often, Nick, about the deductions that they will have when they buy their first home. Can you explain a few of those deductions for us?
Yes, one of the biggest deductions available for buying a home is your mortgage interest. You can deduct interest on debts of up to $1.1 million. Now, when you buy that principal residence, you can also deduct any points paid. If you refinance the mortgage down the road, you would have to amortize those points over the life of the loan. Real estate taxes are also deductible as part of your itemized deductions, as well as mortgage insurance premiums. Now, the deduction for mortgage insurance premiums actually expired at the end of 2013, but we think Congress will retroactively reinstate that, most likely back to the beginning of 2014.
Very good. I know, Ron, you and I have had some deals together that you've done some USD financing, and at this point we're asking a lot of sellers to pay closing costs in the beginning for that first-time home buyer, correct?
Correct, yeah. Any way they can alleviate the amount of money to closing is, for first-time home buyers, things like that is a good idea.
Absolutely. So with those closing costs, Nick, I know you had mentioned buyers can write that off on their taxes. If a seller pays closing cost for that purchaser, first-time home buyer, are those tax deductible as well?
Yes, if it's an individual buying their principal residence, seller paid points are deductible by the buyer.
Okay, so when you go to closing, remember to keep your HUD statement and take it to your accountant, and Nick can determine exactly what can be deducted. Nick, when we talk about investment property, for example, I'm living in my townhome, I decide to keep my townhome as a rental, move into owner-occupied, or I'm into my owner-occupied that Ron has financed, and I want to buy a fourplex. Investment income. Talk to us about some of the ways that you can format those business, the entity structures.
Yes, one of the big misconceptions out there is that one entity structure over the other will save you on taxes, and for the most part that's just not the case. It really boils down to being a legal liability issue. Now, if an individual goes out and buys a piece of property in their own name, they will have no liability protection. Any lawsuits stemming from that rental activity could subject that owner's personal assets to that lawsuit. Now, as an individual owner of a rental property, you would file Schedule E. It's an attachment to your individual tax return. Now, as your portfolio of properties starts to grow, you may feel you want to segregate your personal assets from those in the rental properties. Now, my recommendation there would be to form an LLC, a limited liability company. Now, if you're the only owner of an LLC, it's deemed as a disregarded entity. For tax purposes, it just doesn't exist. You retain that liability protection, however. Now, if you have more than one owner of a LLC, you would file as a partnership. There would be some professional fees incurred there, setting up the partnership and filing that annual tax return. Now, that partnership doesn't pay the tax on the rental property or the rental income. Each partner would receive a Schedule K-1 reporting their share of the rental income, and that rental income is passed down to the individuals and they pay the tax on their individual tax return. Now, there are also C and S corporations available. However, those are not advisable for owning rental property. Primary reason being when you put property into or take property out of a corporation, it gets marked up to fair market value, and you could incur some tax unnecessarily. Now, with the LLC, there are some limitations in being able to get a Fannie or Freddie Mae mortgage, I believe. Is that true, Ron?
Yeah, that is correct. You have to apply for a 30-year fixed secondary market type loan, Fannie Freddie type loan, as an individual. So obviously, an LLC cannot, a corporation cannot fill out an application. So there are different circumstances where if you have an existing LLC, you may be able to move that property into an LLC after you close on it. But as far as the process from the beginning through closing, it has to be in the individual's names.
So, Nick, I have a question, but going back to that LLC. Let's say, for example, Ms. Brown owns 50%, Mr. Smith owns 50%. How, again, do those tax liabilities get passed on?
Well, with the partnership structure, you can really allocate that partnership agreement to allocate the income or losses however you see fit. But typically, if you are a 50-50 owner, 50% of that net income or loss would flow through the one owner, and half of it would go to the other owner.
Understand. Record keeping, I know, is very important to accountants. Can you help and explain the things that are important for your investors to keep for you?
Yeah, the big question here is what is deductible against your rental income, and how are you going to keep track of that? Well, pretty much every expense you incur in order to earn that rental income is going to be deductible. Now, the typical items, you have your property management fees, insurance and commissions, repairs and maintenance on the property, mortgage interest, mortgage insurance premiums, real estate taxes, utilities, homeowners association fees, and that's just a short list. There could be many more items that are deductible against the rental income. Now, how are you going to track all this information during the course of the year? Well, if you only have a couple properties, keeping it on notebook paper or in an Excel spreadsheet may do just fine, and your accountant could understand that. But as your portfolio of properties grows, you may feel you want to digitize that and have it in type of a computer program, such as Quicken is a good, easy to use, easy to learn program with some good reports. If you want to take it a step beyond that, a little more sophisticated would be something like QuickBooks, which is really the industry standard for small businesses. Very powerful. There is a little bit of a learning curve in that it is double entry accounting. However, you can look at some pretty neat reports with all of your properties lined up against each other. A really powerful piece of software there.
Good information. Good information. We talk about investment properties gains and we talk about losses. Passive activity losses. Can you dumb that down for us a little bit, Nick?
Yeah, passive activity losses are really the thorn in the side of owners trying to deduct rental losses. By definition, rental activity is deemed passive in nature by the IRS unless you are a real estate professional. To meet that standard, you really have to spend the majority of your hours during a year in real property trades or businesses. Now, the issue is that the IRS only allows you to deduct passive losses to the extent that you have passive income. Now, that passive income could come from other sources outside of rental activity. There is one exception to this rule, and that is the $25,000 special allowance for rental real estate. Now, to meet that qualification, you have to own 10% of the property, and you have to be actively involved in the management. Now, even if you have a property management company running the property, you can still meet that active threshold. Now, as your adjusted gross income goes up from $100,000 to $150,000, you phase out of this special $25,000 rental real estate loss allowance. Now, thing to note here, if you're not able to deduct those losses in the current year, they don't just disappear. They carry over indefinitely until you either have passive income or you sell that property. The year you sell that property, it will free up all of the passive losses relating to that rental property.
Interesting. Property sales, I know we have long-term gains. We've talked about short-term gains, Nick. Installment sales, could you explain the difference between a long-term and a short-term gain?
Yeah, so when you sell a property, your gain is going to be, so to speak, divided up into a couple different buckets. The gain that is due to depreciation, and this is as you depreciated that property, you reduce the cost basis in that. That is called depreciation recapture, and it is taxed at a maximum rate of 25%. Now, any long-term gain in and above that depreciation recapture, really gain due to appreciation in the property, that is taxed for most taxpayers at a maximum rate of 15%. However, do note that if you are either in the 10 or 15% tax bracket, it is that long-term gains are actually taxed at a 0% rate. That is tax-free income. If you are lucky enough to be in the highest tax bracket, the 39.6% tax bracket, those long-term gains are taxed at a 20% rate. Now, if you didn't own the property for a year, that would be a short-term gain. Short-term gains are taxed at ordinary tax rates, so whatever your highest tax rate you are taxed at. Now, if you have a loss on a property, unfortunately, the good news is that you can deduct that loss in full the year that you sell that property. You are not subject to the $3,000 per year capital loss rules.
Oh, installment sales. When I think of installment sales, are we speaking about seller financing, Nick?
Yes, and there's some really good planning opportunities with installment sales. Installment sales is where you do not receive the entire proceeds in the year you sell that property, and the IRS allows you to pay the tax on the gain pro rata as you receive those proceeds. Now, the big planning opportunity here is, as I just spoke about, being in that 10 or 15% tax bracket, that's a 0% tax rate. And if you can string out the receipts over several years, you may spread that gain over several years. And if you can keep your tax brackets lower, you may be able to create partially or entirely tax-free income on selling that property.
Wonderful. I know we have farmers, we have investors that will do some owner financing, maybe in the form of a second deed of trust. Ron, if you're financing with the first deed of trust, do you need to know about seller financing installment sales that Nick was talking about as a second deed of trust?
Yeah, absolutely. Any money that would come to the closing table, we would have to know where it came from, verify the terms of that money. Yeah, absolutely we would need to, because it also may even limit some of the loan to values and things like that if there is owner financing on top of the first deed of trust.
Understand completely. Speaking about farmers, I know that I have had a couple of experiences in my 26 years with regard to selling farms. And they'll say, I think it's time to sell a family farm, want to do a tax-free exchange as a tax benefit, and would like to sell the family farm and buy maybe a rental at Smith Mountain Lake. Nick, talk to us a little bit about LikeKind Exchanges.
Yeah, a LikeKind Exchange can be a very good planning opportunity. And with a LikeKind Exchange, you defer paying the tax on the gain. You more or less roll that gain into a replacement property. It would only pay the tax when you sold that replacement property. It's not always a great idea, but in many cases, it's a very effective way of deferring tax. A couple qualifications to do a LikeKind Exchange. It has to be business or investment property. It cannot be personal use property. It has to be like-kind property. Now, real estate qualifies for real estate. A business property such as equipment, you could exchange for equipment, but you could not sell a piece of real estate and buy a piece of business equipment. It has to go through a qualified intermediary. When you sell the original property, any proceeds received at closing go to that qualified intermediary, and when you buy the replacement property, that intermediary brings that to the closing table and they are used to purchase the replacement property. Now, 100% of those proceeds need to go to the replacement property, or some of that gain will not be deferred. Now, you do have to step up your investment. You have to buy something of at least equal value. You really have to have as much equity in the replacement property as the original property, such that if you had debt on the original property, you are going to have to take out at least as much debt on the replacement property, or some of that gain may end up being taxable.
I understand. You know, it has taken me a while to get my head wrapped around why someone can sell a farm and buy a rental place at Smith Mountain Lake, but I guess because the farm is business income producing, and if you buy at Smith Mountain, you buy income producing as a rental.
It's real estate for real estate.
Real estate for real estate, but it has to be income producing.
It has to be business or investment.
Understand. Financing for investment property is a little bit different than what we've talked about, Ron, in the past with our first-time homebuyer seminars. Can you give us an update on some feel on real estate real estate financing for investment properties?
Sure. Yeah, I thought I would just hit a couple of the highlights here. It may even start from the bottom of this slide. Investment property is a riskier type loan. It's obviously it's a property other than your primary residence. So if you were to get in some kind of financial hardship and unfortunately had to let something go, you're going to let your rental property go before your primary residence. So for that reason, guidelines are a little tighter. Things are looked at a little differently. The interest rates are higher. The down payments are more, just because they're riskier loans. So. All the normal loan types are available on investment property. Obviously, for today's purposes, we're talking about purchasing an investment property, but you can also refinance them too. If you're in a better rate environment and just want to get a better rate to increase your cash flow, you can do that. You can also tap into the equity that you have in an investment property through a cash out refinance, and I think that's something a lot of people probably don't realize, but that is, you can only tap into it up to a certain percentage of what it's worth, and I think that's 70%. So, but it is available.
I have a question with Nick on that. Are closing costs, if you do a refi, Nick, are those closing costs tax deductible as well on a refinance?
Well, that's going to depend on whether this is a personal use property or whether it's a business property.
Okay.
If it's business property, yes, those would be amortized over the life of the loan, any loan costs there. If it's a personal use property, only the points would be deductible. Actually, they would be, if it was a refinance, amortized over the life of the loan as well.
Okay, thank you.
And the down payments for investment properties, you're looking at a very minimum of 15% down. With a 15% down payment, obviously you would still have to, mortgage insurance would be required. So if you're looking at monthly cash flow and things like that, 15% down with mortgage insurance and trying to turn a profit on the property may not be the ideal situation. So generally we say that 20% is the minimum down for an investment property. If you are purchasing a 2 to 4 unit property, then 25% would be your minimum down payment. And then also going back to the rates a little bit, there's a pricing break between a 20% down payment and a 25% down payment. It's just the way Fannie Mae and Freddie Mac have it set up to where your interest rate's actually going to be a good bit better if you're putting 25% down versus 20%. Although 20% is kind of the minimum to get you out of mortgage insurance. And if you have greater than 4 financed properties already, then your minimum down payment is going to be 25%. As far as underwriting guidelines, everything is pretty much the same as far as how we calculate your normal income from your W-2 job or your self-employment, things like that. The way we figure your income on your Schedule E, which is the other real estate that you own, basically we take your bottom line income or loss from your Schedule E, we add back in the depreciation, add back in the mortgage interest, and then any kind of one-time expense that you may have if you just replaced the roof that year or something like that, we can sometimes add that stuff back in, and then we deduct out your monthly payment with your principal, interest, taxes, and insurance, and that's how we come up with whether you have a monthly income or a monthly loss on the property. Any kind of current leases that are on a property that you're purchasing, and I know I'm a little bit out of order here, I'll go back to the top here in a second, but any type of current lease that you have on the property, you can only use that lease to offset your debt on that property if you have a 2-year history of rental income. So we would take your previous 2 years tax returns to make sure that you have a 2-year history, and if that's the case, then we can use that lease that you're going to bring along with you from the purchase of the property to offset your debt. The amount of financed properties, the maximum amount allowed per the secondary market Fannie and Freddie rules are 10 properties. There are a lot of banks out there that won't do more than 4 financed properties. We can't however, do up to 10 properties. If you're doing something through like a farmers and merchants bank or a private investor, obviously they don't care how many properties you own as long as it makes sense to them. But if you're looking at doing a 30-year fixed financing option through the secondary market, the max you can have is 10 finance properties. Now you can own more properties as long as you don't have liens on more than 10. Converting current residents into an investment, this is something we deal with quite a bit these days. There was some things happening back in the housing crisis. It was called the buy and bail. People were purchasing homes, turning their current homes into investment properties, but then once they closed and moved into their primary residence, they were just letting those homes go into foreclosure. So the guidelines were stepped up a little bit to require a 6-month reserve on both properties. So basically after closing, if you were purchasing a primary residence and keeping your existing home and converted it into a rental, you would have to have 6 months worth of payments on both of those properties in the bank after closing in order to get qualified for that property. We can use checking, savings, we can even use 401ks. As long as we can prove that you have access to that money in hardship times, we can use that to come up with that 6 months reserve, but it is a requirement. The only way out of that requirement is if you can prove that you have 30% equity in your existing property. Obviously, that would have to be done through an appraisal, documenting at least 30% equity. At that point, then we would only require 2 months reserves for both properties. And again, we cannot use the lease income on your current primary that you're converted into a rental. Even if you have somebody coming in to rent that property, we cannot use that unless you show a 2-year history of having rental income on your tax returns.
That's good to know. I know an awful lot of buyers will think that they're going to rent out their basement, but unless you've had the tenant in there for 2 years, you're telling us that we cannot use that against the mortgage to qualify.
Correct.
Absolutely. We did have a question that came in, and Nick, this question is from Linda G. from McGahkeysville, and her question is, she has heard so many times Congress and Senate threatening to take away the mortgage insurance deduction on taxes. What are your thoughts on that?
Well, I believe the mortgage interest deduction, it's been around there for a very long time, and I do not see that going away anytime soon. They've brought up pulling that back, but that just never seems to stick. I would not be worried about that anytime in the near future.
That's great news, because as a realtor, I would hate to lose that deduction for myself and for my clients. And how about you, Ron? How would that affect your business?
Yeah, I mean, I don't think anybody would be happy about it. So.
Absolutely. Again, I thank you so much for attending. We have so many different questions, I'm sure, coming in. Nick, if we would like to get in touch with you and engage you and hire you for your services, how would we do that?
Well, you can contact me at 540-434-5975 or nperrine at pbmares.com.
Great. And Ron, how do we get in touch with you if we want to finance our investment property?
My direct line is 540-208-1850, or you can email me at rross@vbsmortgage.com.
Sounds great. If you're interested in purchasing an investment property or owner-occupied, you can contact myself, Pam Estes, at pamesteshomes.com. My contact information, my email and cell phone information is on my website. I encourage you to go to Old Dominion Realty and visit our webinar tab. On that tab, you can visit and look back on the webinars that Ron and I have hosted. First-time home buyer webinars, preparing your house to get ready to sell. What are some of the other ones that we've talked with?
The appraisal,
That's right.
Appraisal one that we did last time.
Michael Pugh joined us from Colonial Appraisal Company, and we spoke about appraising your property and how important it is to price your house correctly before you put it on the market. Our next webinar is going to be held on July 17th at 6:30, and we're going to be focusing in on property management. Lauren Resnick with Old Dominion Realty Property Management will be joining us that evening, along with Ron and Renee Whitmore for Old Dominion Realty as well. And we're going to be talking with Lauren as to what does she do with regard to property management. What does she do each and every day of renting the property, collecting the rent, repairs, the heat pump goes out, and if you're an investor and interested in hiring a property manager, what would she do for you and what would those costs be? So again, I thank you so much for joining us. Nick, thank you so much.
Thank you.
Ron, thank you again for being with us this evening. Thank you all for joining us. We've had such a good success with our webinars, and thank you so much, and look forward to seeing you in July. Good evening.